Imagine for a moment a company that captured headlines with visions of whisking you away on demand, maybe from Manhattan to the Hamptons for a weekend getaway, or even connecting you to, the glitz of the Monaco Grand Prix, all via a network of air taxis and these futuristic electric vertical takeoff and landing aircraft.
Right.
Sounds like something straight out of a high-tech sci-fi film, doesn't it?
It really does.
Yet, incredibly, that same company's core mission today is ensuring life-saving human organs reach hospitals on time across the entire United States for critical transplant surgeries.
It's a truly extraordinary transformation. And what's profoundly fascinating here is how this dramatic pivot completely redefines its financial landscape and, critically, its investment profile.
Yeah.
We're not just talking about a minor adjustment. This is, a fundamental change in their very reason for being.
Yeah.
Shifting from luxury convenience to, medical necessity.
Absolutely. So today we're taking a deep dive into Strata Critical Medical, Inc., now trading under the ticker symbol SRTA.
That's SRTA.
Right. A company that just went through what can only be described as a fascinating, some might even say audacious, business metamorphosis.
Our mission here is to meticulously connect the dots between its past as a flying car hopeful and its present as an essential, critical medical logistics provider. We'll be dissecting the financial implications of this strategic pivot, helping you understand the why and how of such a dramatic shift.
For a long time, Strata Critical Medical, or what it was known as before, Blade Air Mobility, was virtually synonymous with the futuristic dream of urban air mobility picture air taxis. They were at the forefront of buzzworthy conversations about eVTOL, that's electric vertical takeoff and landing aircraft, promising to zip you from Manhattan to the Hamptons in style, dramatically cutting down travel times.
And that passenger segment, as the sources clearly describe it, was deeply, deeply ingrained in Blade's identity. The vision that positioned Blade at the, bleeding edge of urban air mobility, promising to disrupt traditional transport.
Yeah.
The company's very ethos seemed built around delivering high-end convenience and speed for, discerning travelers.
And it wasn't just talk either. The news headlines from even just a few months ago painted a vivid picture. We saw articles like, eVTOL stocks are on fire back in June 2025, and flying cars are finally here from April 2025. Blade was truly in the thick of it all. As recently as June 3rd, 2025, they were actively participating in what were hailed as the first electric passenger flights in the U.S.
Yeah, I remember seeing that.
They're constant fixtures at eVTOL and AM Advanced Air Mobility Summits, presenting their vision for the future of, intracity and regional travel.
Their operational focus undeniably revolved around this passenger-centric model. Services primarily concentrated in the, highly affluent Northeast United States and Southern Europe.
Makes sense.
We saw numerous reports detailing their partnerships, like the one with Skyport's Infrastructure in March 2025 for planned Manhattan JFK flights, aiming to make airport transfers a breeze.
Right. Skip the traffic.
Exactly. Or the collaboration with Ocean Casino Resort in May 2024, offering direct helicopter flights to Atlantic City, tapping into that luxury leisure market.
Okay.
These weren't merely theoretical aspirations. Blade was actively investing in and building out a tangible, albeit, niche, network.
They even expanded their ambitions internationally, didn't they? Forging partnerships with major airlines like Emirates and Qatar Airways in May and September of 2024.
That's right.
These alliances aim to offer seamless, high-speed connections for international travelers heading to destinations like Monaco, known for its glamour and high-profile events. And for the ultimate in high-end convenience, luxury hotels like Marriott in New York City were offering free JFK helicopter transfers with Blade back in July 2024. This was all about making short-distance, luxury, and highly convenient air travel a tangible reality for consumers. It really paints a picture of a company deeply invested in that premium passenger experience.
Precisely. The passenger segment encompassed not just helicopter and amphibious seaplane flights for short distances, but also non-medical jet charters.
Okay.
This entire segment was clearly designed to position Blade as the go-to premium on-demand air mobility provider.
Right.
This aspirational vision was potent enough to attract significant attention from prominent growth investors, including, as you mentioned, Cathie Wood's ARK investment.
Yeah, that's interesting.
Which notably bought shares in May 2025 and October 2024, when the company was still known as Blade Air Mobility. This highlights the speculative excitement and perceived disruptive potential that the market saw in their original business model.
But as we often see with these highly speculative, forward-looking technologies, the path to widespread adoption and crucially consistent profitability, well, it was proven to be a formidable challenge. The urban air mobility market, while exciting, was incredibly capital-intensive, fraught with complex regulatory hurdles, and faced intense competition from various players, all vying for a piece of the future.
A crowded space.
Very. The grand vision was there, but the ground-level economic realities were becoming increasingly stark. And it was against this backdrop that, just a few weeks ago, Strata made a truly audacious move, one that completely redefined its future. Here's where it gets really interesting and, frankly, quite dramatic. In a move that truly shook up the market just recently, on August 4th, 2025.
Yeah, very recent.
Blade announced it was selling its entire passenger unit to Joby Aviation for up to $125 million.
Wow.
This wasn't just a strategic adjustment or some minor tweak. This was a total operational overhaul, effectively clearing the runway for Blade to focus solely on medical services. It was a decisive, unambiguous break from their air taxi past.
This immediately raises a critical question. Why such a decisive pivot, especially after cultivating such a high-profile, futuristic image? The sources clearly indicate a strategic intent to streamline the business, fundamentally shifting away from the inherently capital-intensive and, frankly, regulatory-heavy air taxi segment. The goal was to concentrate resources on medical logistics, an area where Blade already had a significant, albeit less glamorous, footprint.
Right. They weren't starting from zero there.
Not at all. And the news headlines themselves captured the sheer dramatic nature of this transformation, emphasizing the immediate and profound impact.
They certainly did. Take Zach's headline from August 4th, Joby to buy Blade's passenger unit for up to $125. What's ahead? Or Benzinga's blunt assessment. Blade exits air taxi space, sells unit to Joby to focus on medical logistics.
Yeah,
Very direct.
I'm happy to get you there.
And MarketBeat's headline, How 2 deals in 48 hours changed everything for Joby Aviation, truly underscored the swift and impactful nature of this market-shaking development. This was more than just a transaction. It was a clear, unambiguous divorce from their past identity, signaling a profound strategic reorientation.
The official rationale from Blade was a clear intent to transition into a pure-play medical services and logistics business.
Pure play, right.
This represents a profound and highly strategic shift in market focus. Moving from catering to consumer discretionary travel, essentially a want, to providing essential healthcare infrastructure an absolute need.
Big difference.
Huge. While the Joby deal fundamentally gave Blade a new direction, as one headline noted, Joby deal gives Blade new direction.
Yeah.
The immediate market reaction, often described as the stock lacking lift, suggested that investors were still, digesting the full implications of such a significant and rapid change.
Sure, it takes time to reevaluate.
Exactly. And this period of market reevaluation is precisely what we're going to examine through the financial lens.
So, with the passenger unit divested, what was the final defining step in this complete corporate transformation?
The name change.
It was the name change itself, effective August 27th, to Strata Critical Medical, Inc., and with it, the new ticker SRTA. This wasn't merely a cosmetic change. It's a powerful signal, clearly articulating their unwavering dedication to the crucial role of transporting human organs for transplant and providing vital medical logistics across the nation.
And when we connect this to the broader picture, this transition implies a fundamental shift. From a business rooted in consumer discretionary spending and aspirational future technologies.
The EVDL dream.
To a highly specialized essential services provider. The implications for critical financial metrics like revenue stability, the regulatory environment they operate within, and the competitive landscape they now face are all profoundly significant.
Totally different ballgame.
Completely. This demands a fresh, comprehensive look at their financials, which, frankly, can no longer be evaluated through the lens of a luxury air taxi company.
Good point.
It's worth noting that the company, founded by Robert S. Weisenthal and Stephen Martacci back on December 22, 2014, and headquartered in New York.
So same core leadership, roughly.
It seems so. They maintain their operational foundation and leadership continuity, but now with a dramatically refocused, life-critical mission.
And their new core business truly is incredibly vital, providing specialized air transportation and logistics for hospitals across the United States, specifically as a transporter of human organs for transplants. It's a far cry from flying you to the Hamptons or Monaco. In fact, it's such a stark contrast, almost cinematic, isn't it?
It really is.
From envisioning a future where the biggest crisis is missing your reservation in Monaco, to literally holding lives in the balance, where every minute counts.
Yeah.
This isn't just a business pivot, it's a profound shift in existential purpose and a much more impactful and critical service to society.
Precisely. The stakes are profoundly different. I mean, imagine trying to explain customer satisfaction for a luxury flight versus the absolute non-negotiable success rate required for a timely, safe organ transplant.
Night and day.
It completely reshapes every operational priority, every investment decision, and indeed the entire corporate culture. This medical logistics sector is driven by absolute necessity and precision rather than market desire or speculative growth,
Which could mean
suggesting a potentially more stable, albeit demanding, revenue environment.
now that we truly understand what Strata Critical Medical is and the dramatic path it took to get here, let's dive into the numbers.
Okay.
As of August 29th, the stock closed at $4.37. It experienced a recent daily change of negative 7.61%. Now, any single day's movement is just a snapshot, but it places them with a market capitalization of $357.01 million.
$357 million.
That's a decent size, certainly not a microcap, but still firmly in a category where every strategic move and financial report can feel a bit more impactful or perhaps dramatic for investors.
And the enterprise value, which stands at $250.87 million, is notably lower than its market capitalization.
Okay, explain that difference briefly for us.
Well, for our well-informed listener, this difference is particularly telling for a company like Strata in this transitional phase. It strongly indicates a healthy net cash position, meaning they likely hold more cash than they have debt, or very minimal debt overall.
Ah, okay. So cash heavy or low debt.
Exactly. This substantial financial flexibility is absolutely crucial for a company undergoing such a radical business transformation. It gives them the runway to invest heavily in building out their new medical logistics capabilities without the immediate pressure of servicing high debt.
Right. Gives them breathing room.
It offers them significant strategic maneuverability.
Their shares outstanding are 81.70 million, with a public float of 56.73 million shares. This suggests that a pretty significant portion of the company, the difference between outstanding and float, is held by insiders or large institutional investors.
Yeah, about 30% not floating publicly.
Which is a factor we'll definitely explore further when we look at ownership structures.
Right. This foundational market data gives us the essential context for analyzing the financial statements that follow. While the recent daily dip is a short-term market fluctuation.
Noise, mostly.
Right. Our focus will be on the underlying financial health and growth trajectory as the company fundamentally reorients itself towards its new critical mission. We need to assess if the balance sheet provides the stability needed for such an ambitious pivot.
Okay, so on the revenue front, things look surprisingly strong, even impressive. They pulled in $254.34 million in total sales.
Solid number.
And perhaps more importantly, they're still very much in growth mode. We're seeing sales up 6.7% year over year in the trailing 12 months.
Positive growth.
And a healthy 4.2% quarter over quarter. Plus, that robust 70.9% sales growth over the past 3 to 5 years tells a compelling story of an expanding business.
Yeah, that historical number is huge.
Likely propelled by their previous passenger services and the initial build-out of their medical segment, I imagine.
Indeed, this consistent sales growth, even when considering the recent mixed EPS surprise, strongly suggests that demand for their services encompassing both their historical passenger business and, increasingly, their current medical logistics has been steadily expanding.
Okay.
This positive top-line trend is absolutely crucial, particularly for a company navigating such a profound transitional phase, as it demonstrates ongoing market acceptance and need for their offerings.
But you mentioned a mixed EPS surprise.
Right. It's vital to acknowledge the mixed picture from their last earnings report on August 5th. They posted a 16.55% EPS earnings per share surprise, meaning they missed analyst expectations on the bottom line.
Okay, missed on profit.
But delivered a positive 10.50% sales surprise, beating revenue forecasts.
So beat on revenue, missed on earnings.
Exactly. This stark contrast indicates that while they are successfully growing their revenue, achieving profitability is still a significant challenge, or at least lagging market expectations as they invest in their new direction.
Got it. So here's the flip side of that coin. When we pivot to profitability, the picture gets a bit more challenging. They reported a significant negative income of $18.98 million, to be exact.
Yeah, in the red.
And when we look at their margins, it really drives the point home. While their gross margin is positive at 21.96%.
Okay, so they make money on the direct service itself.
Right, but it quickly turns negative when we consider their operating margin at negative 9.61% and their profit margin at negative 7.46%.
Oof. So overhead and other costs are eating up more than the gross profit.
Precisely. It clearly tells us that despite successfully growing their sales, they are not yet consistently generating a profit from those revenues.
This is a critical insight for our listener, particularly as we evaluate a company in transition. The negative operating and profit margins clearly indicate that while Strata is generating substantial revenue, its total costs of operations, both direct costs and indirect operating expenses like admin, R&D, are currently exceeding that revenue. Furthermore, all of their key return ratios are also in negative territory. Return on assets at negative 7.05%, return on equity at negative 8.39%, and return on invested capital at negative 8.31%.
All negative returns.
Collectively, this suggests that the capital being deployed into the business is not yet generating positive financial returns, which is a significant hurdle they must overcome in their new pure-play medical focus.
And their earnings per share, or EPS, echoes this profitability challenge. It's consistently negative in the trailing 12 months at negative 0.24, with next year's estimate still projected to be negative at negative 0.14.
Still losing money per share, projected.
Though, interestingly, EPS for the next quarter is estimated at 0.000, suggesting a potential break-even point or at least a stabilization on the horizon.
Perhaps. A sign things might be turning, but not quite there yet.
This pronounced contrast between strong sales growth and persistent unprofitability is quite striking and underscores the complexity of their current financial state.
However, this brings us to a crucial point for investors, the forward-looking EPS estimates.
Okay, what are analysts expecting?
Analysts are projecting a positive EPS growth of 11.37% for next year and a robust 55.32% over the next 5 years.
Wow, 55% growth projected over 5 years? That's significant.
It is. This suggests a significant market expectation that this new pure-play medical focus will indeed lead to improved operational efficiency and ultimately a return to profitability down the line.
So the market thinks the pivot will work eventually.
It implies that current losses are, in part, seen as an investment in the future, with the market anticipating a pivotal turnaround in their financial trajectory. It's a show-me story for the bottom line, despite the compelling top-line growth.
Show me story. Okay.
The market is giving them the benefit of the doubt that this strategic pivot will yield financial fruit.
Now, here's where we shift to a much brighter financial picture, almost a sigh of relief for any investor looking at Strata. Their balance sheet looks incredibly robust.
Yes, this is a key strength.
With quick and current ratios both standing at a remarkable 5.95. They possess a significant cushion of liquid assets. This indicates an ample ability to cover their immediate short-term obligations, a sign of exceptional financial health and a strong capacity to weather any unexpected operational or market turbulence.
Absolutely. Those liquidity ratios of 5.95 for both the quick and current ratios are not just strong, they are exceptionally strong.
Really stand out.
For a company like Strata Critical Medical, especially one undergoing such a significant transformation, this is a major asset. It means they possess substantial current assets to comfortably cover all their short-term liabilities,
Right.
providing immense financial stability and operational flexibility.
Right.
This robust liquidity is further underpinned by a healthy cash per share figure of $1.41, giving them a considerable cash war chest for their strategic investments.
And even better, their debt situation is remarkably low. Their debt-to-equity ratio is a mere 0.04, and the long-term debt-to-equity is an even lower 0.02.
Practically zero debt relative to equity.
This incredibly low reliance on debt financing truly highlights that they are not heavily reliant on borrowing to fund their operations or growth. It's a conservative financial posture that provides a lot of room to maneuver.
Indeed. The combination of these exceptionally low debt-to-equity ratios and their robust liquidity paints a picture of a company that has primarily been funded through equity or, historically, strong operational cash flows.
Despite the current unprofitability.
Right. Rather than accumulating heavy debt. This financial conservatism is absolutely critical, providing a rock-solid foundation as they navigate this significant strategic pivot.
Makes sense.
It offers Strata the crucial flexibility to invest aggressively in scaling and refining their new medical logistics segment without the immediate and burdensome pressure of high debt servicing costs or restrictive loan covenants.
Yeah, that debt pressure can kill a transition.
Exactly. This strong balance sheet could very well be the key enabler for them to ultimately turn those profitability metrics positive, by allowing them to focus resources on execution rather than debt management.
Okay, let's shift our focus. When we turn our attention to who actually owns Strata Critical Medical, two numbers really jump out at us, and they paint a compelling picture of conviction.
Ownership is key.
Over 30%, specifically 30.55% of the company is owned by insiders.
That's high.
Very high. These are the people intimately running the show, the management, the directors, those with direct personal knowledge and a very significant financial stake in the company's performance.
Skin in the game.
A lot of skin in the game. That's a powerful alignment of interests, suggesting those closest to the business truly believe in its future, or at least hold a lot of stock.
Right. And this concentration of ownership raises an important question for you, the investor. What does such high insider ownership, coupled with an equally substantial institutional ownership of 57.56%, truly signal?
57.56% for institutions, also very high.
Extremely. High insider ownership often suggests profound confidence from those who possess the deepest understanding of the business, directly aligning their personal financial interests with those of external shareholders.
Makes sense.
Similarly, high institutional ownership indicates that professional money managers, the large investment funds with extensive research capabilities, also see compelling long-term potential, even given the current profitability challenges and the recent dramatic business model transformation.
So the smart money is heavily invested.
They've conducted their due diligence and are committing significant capital based on their conviction.
So when you combine those figures, we're talking about nearly 90% of the company held by individuals and entities with a deeply vested professional interest.
Yeah, almost 88% combined.
On the surface, this generally speaks to a strong collective belief in the company's trajectory and its future success. It's not a company widely dispersed among retail investors, but rather tightly held by those who've presumably done their homework. But here's a detail that adds another, perhaps more intriguing layer to this ownership puzzle: the insider trading reports.
Ah, yes, the actual transactions.
While the overall insider ownership is high, we see a repeated and quite consistent pattern. Key executives, including the CEO, CFO, president, and other top leaders, have been exercising stock options.
Buying low.
Essentially buying shares at a predetermined, often lower price, and then almost immediately turning around and selling a significant portion of those shares.
Okay, exercising and selling. Common. But
We're talking millions of dollars in sales by the very people steering the company. And this pattern has continued right through their business model transformation. It begs for a closer look.
this pattern of insider selling creates a fascinating tension, doesn't it? And it's something investors need to scrutinize carefully. While executives are often expected to monetize their equity holdings, especially when a significant portion of their compensation is tied to stock options.
Right, it's part of their pay.
The sheer volume and consistent timing of these sales, even as the company announces a transformative pivot, raises a critical question for investors. Does this activity merely reflect standard personal financial planning? Maybe for liquidity or tax diversification?
The standard explanation.
Or does it, perhaps more subtly, signal a slightly more cautious near-term outlook from those closest to the strategy, potentially contrasting with the public strong buy consensus from analysts we'll talk about?
Interesting contrast.
It forces us to scrutinize management's conviction with an extra layer of caution, seeking further clarity.
Let's get specific with some of these transactions to truly grasp the scale. The CEO, Robert S. Weisenthal, made a very notable sale. 2,100,000 shares for $6,762,000 on November 14th, 2024.
Wow, over $6.7 million.
That's a truly substantial transaction, clearly indicating a significant realization of value. We also see the CFO, William A. Hayburn, with multiple sales, including 103,690 shares for $520,507 on January 6, 2025, and another 100,000 shares for $406,590 on June 9, 2025.
Consistent selling there, too.
And President Melissa M. Tomkiel also executed a sale of 100,000 shares for $407,530 on June 9, 2025. These aren't minor divestitures. These are substantial amounts of capital being taken off the table.
That's right. And this consistent pattern extends beyond just the top three executives. It encompasses other key individuals, such as Chief Accounting Officer Amir Cohen and Directors John Borthwick and Reginald Love.
Okay, so it's fairly widespread among the leadership.
We observe numerous instances of option exercises followed by sales, consistently occurring throughout late 2024 and well into 2025. What's particularly noteworthy is that this activity continued even into August 2025, right after the monumental business transition announcement.
Timing is interesting there.
Very. While these transactions are often pre-scheduled or for liquidity purposes, their frequency and sheer volume are certainly details that investors keen on gauging management's conviction will scrutinize intensely. The overall insider trans percentage for SRTA, in fact, shows a net selling trend of netical 1.17% over the latest reported period, reinforcing that the selling activity has outnumbered buying.
Okay, so net selling by insiders recently. Shifting gears to the analyst community. They seem remarkably bullish on SRTA.
Yeah, quite a contrast there.
The company holds a very strong recommendation rating of 1.00, which, for our listeners, indicates a unanimous strong buy rating across the board.
1.0 is as good as it gets. It means every analyst covering it says strong buy.
The current consensus target price stands at $5.83, offering a decent upside from today's price of $4.37.
About 33% upside potential based on the target.
But what's truly fascinating is looking back at some of the older analyst targets. Before this massive pivot, we saw targets as high as $16.
$16, yeah.
That's a dramatic reevaluation.
This discrepancy between past and present price targets raises a profoundly important question for investors. Why such a significant change in outlook?
Right.
The higher past price targets, like those ranging from $13–16 issued by prestigious firms, Ladenburg Thalmann, Oppenheimer, JP Morgan, Deutsche Bank, Credit Suisse, Citigroup between 2021 and 2023.
Big names.
Were almost certainly based on the highly speculative, high-growth potential of the nascent eVTOL and passenger air mobility market.
The flying car hype.
Exactly. That was an industry brimming with disruptive promise, where future potential was heavily priced in. The valuations are tied to a vision of flying cars transforming urban travel.
Exactly. I mean, Citigroup and JP Morgan both had $16 targets back in 2021. That's nearly quadruple the current consensus.
Huge difference.
Compare that to the $6.50 target initiated by Lake Street in February 2025, which, while still positive, is a stark recalibration. It shows just how much the market's entire perception of the company's value proposition has changed.
Indeed. The current target, while still positive and reflecting that strong buy consensus, represents a fundamental reevaluation by the market and by analysts. The medical logistics market, by its very nature, is more mature, less speculative, and arguably has a more predictable, but perhaps less explosive growth profile compared to the wild frontiers of urban air mobility.
Slower, maybe steadier.
Potentially. This implies that analysts are now re-rating the company based on its new, more grounded and essential, though perhaps less glamorous, business strategy. The previous valuations were predicated on the audacious, disruptive potential of flying cars.
Right.
Whereas the new valuation focuses on the critical, non-discretionary services of organ transport. This re-rating is a crucial signal for investors. The rules of engagement for valuing this company have fundamentally changed.
Now, let's look at the stock's actual performance. It's been a bit of a roller coaster, to say the least.
Volatile is the word.
In the short term, it's shown a mixed bag. Down 1.13% this week, but up a healthy 9.52% this month, and a solid 25.21% this quarter.
Okay, strong recent quarter.
Over the last half year, it's gained 29.29%, and it's up nearly 40%, 39.17% to be precise, over the past year. On the surface, those recent numbers sound quite encouraging.
But when we connect this to the broader picture, this recent positive momentum over the past few months might be a tangible market reaction to the strategic clarity offered by the Joby deal and the decisive pivot to medical services.
The market likes the new focus.
Suggests a renewed, albeit cautious, investor interest in its clearly defined new path. However, for a complete and objective analysis, it's absolutely crucial for our listener to look at the longer-term performance.
It should tell.
A more sobering story.
And when you zoom out to the 3-year and 5-year marks, you see significant, frankly, quite steep declines. The stock is down 17.70% over 3 years and a striking 56.73% over 5 years.
Ouch. Down over 50% in 5 years.
This indicates a substantial erosion of shareholder value over those longer horizons, most likely attributable to the challenges, high capital burn, and ultimately unfulfilled promises of the previous air taxi business model.
Sounds about right.
This stock certainly doesn't just sit still, with a beta of 1.77.
High beta.
It's significantly more volatile than the broader market. Its ATR, average true range of 0.28, further confirms this inherent price volatility. Moves around a lot each day.
That long-term underperformance is a key piece of the puzzle. It reflects the historical struggles of Blade Air Mobility to achieve consistent profitability and scale in that highly competitive and capital-intensive passenger air mobility market.
Makes sense.
The stock's higher volatility, indicated by its beta of 1.77, means that it typically moves 77% more than the broader market in either direction, up or down.
So higher risk profile.
Absolutely. This characteristic demands that investors considering SRTA have a higher tolerance for risk. Interestingly, its current price is above its 20, 50, and 200-day simple moving averages.
Okay, some positive technical signs recently.
Suggesting some recent positive momentum has indeed built up despite the daily dip we saw. And its RSI, Relative Strength Index, at 52.18 is hovering in neutral territory. Neither overbought nor oversold.
So technically kind of in the middle right now?
This technical picture suggests a period of reevaluation where the market is trying to find a new equilibrium post-pivot.
A couple of other interesting tidbits for you. Cathie Wood's ARK investment had picked up shares in May 2025 and October 2024 when it was still Blade Air Mobility, trading as BLDE.
Yeah, we mentioned ARK earlier.
This indicates a prior interest from a very prominent, high-growth focused investor.
Right, known for betting on disruption.
Also, the company, with its 322 employees.
Okay, decent size operationally.
Just IPO'd back in late 2019, specifically November 5th, 2019, which means it's still a relatively young public company navigating these waters for only a few years.
What's really fascinating here is that the prior interest from high-growth, disruptive technology investors like Cathie Wood clearly shows the speculative excitement that once surrounded the former business model, particularly its association with the future of eVTOLs.
Yeah, the hype was real.
Now, as Strata Critical Medical, the company shifts towards a more specialized, essential, and arguably more stable service. It will be incredibly interesting to observe whether this new, potentially more predictable identity continues to attract such growth-oriented attention, or if a different class of investor emerges.
Like who?
Perhaps one more focused on stability, critical infrastructure, and consistent profitability emerges as the dominant holder.
Interesting thought.
The employee count of 322 gives us a sense of its operational scale. A mid-sized operation that has clearly demonstrated its agility and capacity to adapt to a radically new, life-critical mission.
So after meticulously breaking down all these numbers, dissecting the news, and tracing their incredible journey, what does this massive strategic pivot truly mean for Strata Critical Medical? It appears to be a highly calculated, indeed courageous move to enter a more focused and potentially much more stable market.
Absolutely. When we connect this to the broader strategic landscape, the medical logistics sector, particularly the specialized area of organ transport, is fundamentally a mission-critical service.
Right. Lives depend on it.
It exhibits significantly less price elasticity and possesses far clearer, more predictable demand drivers than the discretionary luxury air travel market.
Demand isn't optional.
Exactly. This pivot could lead to far more predictable and stable revenue streams for Strata and, critically, a more defined and achievable path to consistent profitability, which has demonstrably eluded them in their past incarnation. Exiting the capital-intensive passenger segment also logically implies substantially reduced capital expenditure on luxury aircraft and extensive marketing, allowing for potentially increased operational efficiency by focusing all resources on a single, vital service.
It's a fundamental shift from catering to a want to fulfilling an undeniable need. People want to fly to the Hamptons or the Monaco Grand Prix, but hospitals and patients desperately need organs transported urgently for life-saving transplants. That's a profound difference in market dynamics. The speculation around eVTOLs was undeniably high, often reaching fever pitch, but the actual economically viable path to profitability for mass consumer adoption seemed distant and fraught with arduous development for many players in that space.
Precisely. By becoming a pure-play medical services and logistics business, Strata aims to capitalize on a market that is inherently less speculative, driven by an unwavering critical demand.
Right.
And potentially offers higher, more stable margins once their operational efficiencies are fully achieved. This move also significantly simplifies their regulatory landscape.
How so?
They're moving from the complex, evolving air traffic control issues for general passenger aviation to a more specialized, albeit equally stringent, set of medical transport regulations.
Okay, more focused regulation.
This focused regulatory environment could allow for more targeted compliance and operational excellence, which is paramount in their new high-stakes field.
It's truly a complex financial picture, isn't it? On one hand, we see fantastic liquidity and almost no debt. That's essentially a dream scenario for many companies, providing a rock-solid financial foundation.
Huge plus.
On the other hand, they're not making money right now, reporting significant negative income and margins.
A big negative.
It's a powerful reminder that you absolutely cannot just look at one number or one aspect when evaluating a company, especially one in the midst of such a monumental transformation.